This CKNW podcast is brought to you by Destination Toyota in Burnaby, BC's #1 Toyota dealer for the sales purchase experience.
I'm so pleased to have Don Cox back with us. Don, of course, has been one of my favorite advisors over the years, chairman of Cox Advisors. Don, this was a great week to get you on because obviously June 19th, I think it was, Ben Bernanke stands up, says we're going to taper, the quantitative easing and slow down that money creation. Bang, the market reacts. We got the big tanking in the stock market, gold market, et cetera. Well, wow, I guess he changed his mind by this past Wednesday evening because look at the opposite. I mean, what the heck is an investor supposed to do when it's that level of sort of interference?
Well, the point is that it illustrates that the market has been driven for a long time now on financial liquidity, not on economic performance. And that as we're like somebody who is canoeing on a river where there's a nice, gentle current, and so you don't have to paddle too hard. And all of a sudden, somebody says, hey, there's a waterfall ahead. So, of course, what you do is you paddle into shore, right?
Mm-hmm.
And then you get to shore and you're unloading your stuff. And I said, gee, I didn't on map, it didn't show that. And they said, well, what I meant was that there's a waterfall on this stream, and we're going to see it one of these days. Okay?
Yeah.
And it may be days away, and we may be able to complete the trip. So what we've got here is that the kinds of things that you and I have acquired experience in making investment appraisals are less and less relevant when what you have is this shadow group here and in other countries where they're highly levered players, and that they as one of my great Wall Street friends said, that their time horizon is lunch. And so what you've got then is it's so hard for a pure investment concept to come in. That's the one thing. The next thing is that what we did to the stock market over the last 2.5 years was for investors who were actually saving, said, okay, bonds are at a level where you're not making any money on them. You can get more income, and of course you get a tax advantage by having dividends. So invest in dividend stocks. And that worked for a while until we got to the stage that you looked at it, and so a lot of these companies can't increase their dividends anymore, and then they started issuing bonds in order to pay dividends, so not to do anything about the economy. So what has been worrying me more and more is that we're eroding the basic sinews of capitalism here, and that therefore the long-term damage is threatening. You know, I've been referring for 4 years to the concept of financial heroin, and based on my father's experiences as a battlefield surgeon in World War II, which is that the soldiers would be seriously wounded, and the only anesthetic that would work was heroin. But the key thing, he said, was learning when to take them off the heroin and put them on morphine, because you didn't dare leave them on it too long or they would be destroyed as human beings. And so the problem we have with this financial heroin is that we're taking away the basic price mechanism of capitalism, which is pricing according to risk and reward. And this really worries me about the long-term effects when we do come out of this, that we're not going to have the kind of lustiness and risk-taking in it, because the stocks that have done best in the S&P tend to be those with the most highly observed dividends. And this doesn't apply as much in Canada, of course, but what's frightening is that we are draining out the basic concepts of risk and reward. And so I was really delighted when Bernanke's first statement came out. I said, this is the best news we've had in a long time, even though the markets were in turmoil, because we weren't going to take the world off the financial heroin without some screams of pain. But without taking them off the screens of pain, we risk the fact that what we're going to have is a bunch of epicene underperformers, and that means we'll never have a strong economic recovery. So then when Bernanke appeared to contradict himself on this and everything went soaring back again, what that did was reinforce my views, Michael, that we're not relying on a capitalist economic recovery. What we're saying is we're just going to drift here. And so there's only one really good news story in the whole world right now, and that's Japan. And they're doing it by massive reliquefaction. But this comes in a stock market where of the top companies on the Nikkei, nearly half of them have no funded debt. Because for the last 15 years, nothing's been going on. I've been piling up money and not taking on bond debt. So that when you get the stimulus coming in Japan, if these guys decide now that they are competitive because of the yen being at par, they are in the strongest financial position for an economic recovery in the modern history of capitalism, and nobody is taking this seriously enough. Well, I've been telling people now for the last 6 months that Japan is the big story. And they say, oh, no, come on, look, they've been lousy for years. Yeah, but that was my book, was a triple waterfall crash. And I said it's not going to be over until it's over. But when you're out of your triple waterfall, then you've really cleaned yourself out and you're ready to go. So I think that is the good story. And you're sitting in Vancouver where there's going to be a lot more economic activity going on there because of the growth in demand from Japan.
Let me ask you just back to a couple things there, Don, and I know we have to take a break in a couple of minutes and your time's short, but I want to, is there a way of getting out of this sort of financial heroin, as you say, heroin rather, the quantitative easing, the liquefaction, whatever we call it, is there a way of getting off that? Not just pain, I mean, yeah, there'll be some disruption, but without, say, more significant pain, let's call it.
I don't believe it. I believe what you have to have is you've got to shake up the system and drive out the greedy levered players who have been borrowing to the hilt and getting a nice return. What you've got to do is get it to a situation where the people that are in there are serious investors and are looking for longer term growth. And there's been no solicitation for them now for the last 3 years.
And let me come back to the Japan point you're making. So again, as investors are looking for opportunities, you'd kind of like maybe, it depends, and I'm being very general, I know that, but, Japanese stocks, so I could go a Japanese ETF, for example, or a fund that specializes in that direction. I just want to clarify for people.
That's right. Mm-hmm.
And no worry about the relative strength of the yen that we might make money, and it certainly has been a great trade, by the way. We might make money on the stock side but lose some of it back on the yen depreciation side, or do you think the depreciation of the yen has sort of slowed down at the very least? It doesn't mean it can't nickel and dime a bit.
The people who went long the stocks and short the yen made money until all of a sudden they didn't, and they discovered they were making the same bet both ways. So I'm recommending this time, I think we may go to 110, 115 on the yen, but I would, for serious investors, I don't think it's worth the loss of sleep at night by having the short side of it here. Mm-hmm. At par on the yen, with these stocks that I think are now saying that with these bulletproof balance sheets they have, you don't need to make that kind of play, I don't think, Michael.
Yeah, and that point you're making, just to highlight it, that you were saying, because I was very impressed with it, that Japanese major corporations, I mean, half of them have absolutely no debt. So while governments are sort of going in debt, the companies are sort of have long since straightened up their balance sheets. So there's a real distinction there to be made that you have.
That's the point. There's no other industrial economy in the world where the corporate sector is in such strong financial shape.
Great stuff. I'm talking with Don Cox, I'm hesitating because I can't start another subject. I got to take a break. I'll come back. Don is chairman of Cox Advisors, but I will come back and I'm going to ask Don about gold and I'm going to ask Don about the commodities in general when we come back with Don Cox right across the Chorus Radio Network. Hey, glad you're listening to Money Talks. I'm really